Okay, we are on slide 3, 20 minutes into I wasn't gonna, I was gonna swear, but I'm not gonna swear. But 3 slides in, 20 minutes under our belt, we're working at a good pace. Not. Anyway, if you're curious, yes, I'm hungry. Okay, it's 1 o'clock, so I'm gonna get through this and then I'm gonna leave and go get something to eat. Okay, so flexible budgets, okay? We've already sort of talked about flexible budgets, so I'm going to really try to keep this short and simple. Not even going to. Uh, a master budget is what we talked about in chapter 7. A fixed budget is something that we tend to do at the beginning of the period, and it's based on a fixed amount of units. Okay. A flexible budget is a budget that we can change the volume of units. Okay, and we can do it in all sorts of different types of situations. But in essence, okay, in essence, a fixed budget, which is what the first column is based on a static number of units, right? So we can't really change the number of units, and actual results are based on what we actually did. And so it's really hard. It's not really hard, but there's a lot of information that we cannot glean from comparing a fixed budget that we prepared at the beginning of the period to actual results. And I'm not going to go through every single one of these line items, but the first one is sales, and there's a $25,000 difference in sales, right? Our budget assumed we would make 80,000, and it turns out that we made 105,000 in sales. And so the variance is 25,000, and again, it's favorable because if my sales are more than what I anticipated, all else equal, I'm thinking my income is higher. And if my income's higher, then it's a favorable variance. But man, I really can't tell. I'd have to do some calculations, but I can't tell whether the $25,000 is solely related to because I sold more units, or is it the fact that I sold more units and I sold at a higher price, or did I lower my price? The same can be said for variable costs, right? Our original budget was 36,000, and it turns out we incurred 54,000. If my costs are more than I anticipated, regardless of the fact that I sold more units, it's going to be an unfavorable variance. And again, I don't really know whether or not it's a variance because we sold more units, or it's some combination of whether we sold more units or things cost more in general. Okay. So, in general, flexible budgets, what we haven't really talked about is maybe this slide. We can create flexible budgets at the beginning of the period, and we can do so by suggesting, hey, you know what? What happens if my sales volume is 10,000 units? Or what happens if my sales volume is 14,000 units? What is my income going to look like under, a best case scenario and a most conservative case scenario? And so here, these are our assumptions, our per unit assumptions. And obviously, sales is variable. The more units I sold, the more I would likely make. And then we have all of these variable costs. And so what we're saying, what we said in a previous period, if I sell more units and my variable cost per unit stays the same, my total costs are going to increase. So for instance, if my direct material is $1 per unit and I'm going to sell 10,000 units, then my material cost would be 10,000. If I sold 12,000 units and my material cost was $1 per unit, my material cost under that assumption would be 12,000. Okay. But it's giving us, well, before I maybe jump to the bottom, here are my fixed costs. And remember, fixed costs do not change based on varying levels of production and sales. So regardless of whether I'm selling 10,000 or 14,000, my fixed costs in terms of machinery, it's going to remain the same. Okay. A flexible budget performance, right? So in this particular schedule, it looks like we are comparing actual results to a flexible budget, right? So again, the previous slide, this slide, is something that I can do at the beginning of the period where I estimate what my potential income could be under various scenarios. And that is very valuable to me, and it helps me sort of gauge where I'm heading. But then this next slide is we are now at the end of the period, and I really want to compare my actual results to the flexible budget, right? And I'm just going to draw over here. I have my budget, my static budget. Then I can have my flexible budget, and then I can have actual results. Okay. So the difference between actual and flexible is what we call the price variance. The difference between budget and flexible is what we call volume. The vast majority of this chapter is based on this variance, which is what we're looking at. Actual results relative to the flexible budget. So we are on this side of the equation. And in this particular example, our actual results were based off 12,000 units. And so we're going to create a flexible budget assuming 12,000 units. And when I get down to material cost, my actual material cost was 13,000, and my direct material cost under the flexible budget was 12,000. My actual costs were more, therefore it's a unfavorable adjustment. Okay. I want to say that I've belabored this. However, a prelude to the next topic is just because I have $1,000 unfavorable variance as it relates to materials, it's not okay for me to assume that the additional cost, right? The difference between 12,000 and 13,000 was the result of the fact that my material cost more. Remember, the next level down is, are we talking about the price of the material, or are we talking about the efficiency of which we used the material? Okay. It could be one of those two things. And so the next learning objectives are really going to be dedicated at these types of variances.